You've tuned in to The Deep Dive, and thanks for joining us. We've got some interesting stuff today, specifically a market report looking closely at Spokane's multifamily scene.
That's right. Focusing on Q1 2025.
Exactly. And what we want to do here is, cut through all the data points and figure out the key trends, especially how does this quarter stack up against, well, 2024?
Yeah, that comparison is crucial. 2024 was a big year for construction, so seeing how things are landing now in early 25, it's important.
Okay, let's unpack this. What's the big picture, the overall market feel right now?
Well, the main headline, I'd say, is that the Spokane apartment market seems to be moving towards a better balance, between supply and demand
Okay, balance.
after last year.
Right. In 2024, we definitely saw construction outpacing how quickly units were getting filled. That pushed vacancy up, but the pace of that increase did slow down as the year went on.
So the Q1 data, does it suggest we're maybe past the worst of the vacancy surge?
The signs are pointing that way.
Yeah, right.
I think the indication is that we're likely past peak vacancy for this cycle. Okay, that's good news. Doesn't mean it'll disappear overnight, but
Exactly, not a plummet, but the trend looks like it's stabilizing.
let's nail down the numbers then. What is the vacancy rate for Q1 2025? And how does that compare to Q1 last year?
So for Q1 2025, the overall vacancy rate landed at 8.0%.
8%. And last year?
A year ago, Q1 2024, it was higher at 8.7%. So a modest improvement year over year.
A step in the right direction. Now, does that 8% look different depending on the type of apartment building? Like the newer fancy ones versus older ones?
Oh, definitely. There's a clear split. If you look at the property classes, the 4- and 5-star properties, those newer high amenity places, they're sitting at 11.2% vacancy.
Ooh, double digits.
Yeah. Then you have the 3-star kind of mid-range. They're better off at 7.8%. And the 1- and 2-star properties, the older, more basic stock, they're the tightest at 5.9% vacancy.
Okay, that kind of makes sense. Newer, maybe pricier units take longer to fill. What about geographically? Is vacancy spread evenly across Spokane?
No, not really. The report shows North Spokane and some of the, let's say, outlying county areas saw the biggest jumps in vacancy over the past year.
And that's tied to new construction.
Directly, yeah. A lot of the new supply came online in those specific submarkets. But in the more established areas, where there wasn't as much new building, rates were much more stable.
Like Spokane Valley or downtown.
Exactly. Those areas and others where maybe the initial wave of building is slowing, they're expected to stay in the single digits generally.
So it really depends where you look. The key thing then is absorption, right?
Right.
Leasing up those new units.
Precisely. And the expectation is with construction slowing down, which it definitely is, the market gets some breathing room to absorb what's already built.
Which should hopefully bring those vacancy numbers down gradually.
That's the outlook. For you, the listener, that could mean maybe a slightly less competitive environment for finding tenants down the road.
Okay, let's switch gears to rents. Always top of mind. What's the average asking rent looking like now in Spokane?
Right now, the average asking rent is hovering around $13,360 a month.
$13.60. And how does that compare nationally?
Still quite a bit lower than the national average.
Okay. And growth. How much have rents actually gone up in the last year, say, compared to the year before?
It's been very slow. The 12-month rent growth as of Q1 2025 was only 0.2%.
0.2%. Wow.
Yeah. Compare that to Q1 2024 when the 12-month figure was 0.5%. And if you look back further, the 10-year average annual growth is more like 3.7%. So we're definitely in a cool period.
What's putting the brakes on rent growth so much? Still the new supply.
That's the main story, yes. All that new construction hitting the market in 2024 really flattened things out. Overall rent growth last year was basically zero.
And I remember hearing about concessions.
Exactly. Especially in those 4- and 5-star buildings, we actually saw some slight declines in asking rents there, and landlords were definitely using things like a free month or two to get people in the door.
But not across the board.
No, interestingly, the 1- and 2-star properties, the more affordable end, they actually saw slightly positive rent growth. And the 3-star stuff is pretty flat.
And did that vary by area too, like the vacancy rates? North and South Spokane maybe saw declines?
You got it. North and South Spokane both had negative rent growth in 2024, again, tied to all the new units and those incentives. Even Spokane Valley, despite decent absorption, had pretty muted growth because they were still leasing up a lot of new product.
So for someone looking now, maybe in those areas, there might still be deals.
It's possible, yeah, especially if buildings are still in that initial lease-up phase. Might find some of those concessions still lingering.
Okay, so Looking ahead through 2025, what's the forecast for rents? Will they pick up?
The general thinking is yes, they should. As that pressure from the new supply eases off, we could see rent growth start to gain some momentum again.
Back towards that historical average.
Potentially. The report suggests we could get back towards that, pre-pandemic average of around 4% annually by the end of this year, 2025.
But there's a catch, right?
Always. It really hinges on the local economy holding up. We need continued job growth, continued population growth. If those slow down significantly, it'll definitely cap how much rents can realistically increase.
Makes sense. It's all connected. Okay, let's talk construction itself. We know it's slowed, but what are the numbers? How many units came online recently?
In the 12 months leading up to Q1 2025, so roughly Q2 24 to Q1 25, about 1,600 market rate units were delivered.
1,600. And the breakdown.
It was split pretty evenly, actually, around 840 in the 4 and 5-star tier and about 770 in the 3-star segment.
And what's under construction right now as of, say, early April?
That number's come down quite a bit. It's around 860 units currently under construction. That represents about a 2.0% increase to the existing inventory still in the works.
860. That does sound way lower than what we were hearing a year or so ago.
Oh, absolutely. The peak was back in 2023. We had something like 300 units going up then. So yeah, a major deceleration.
3,300 down to 860. Wow.
And maybe even more telling, 2024 saw the fewest new construction starts since way back in 2012.
2012. So developers really hit the brakes on starting new projects last year.
They did. And it's not too surprising, really.
Why the big slowdown in starts? Higher interest rates.
That's a huge factor. Financing is just much more expensive. Plus, you still have elevated costs for materials, and lenders have generally tightened up their purse strings for new development. It makes the math harder.
So developers are being more cautious. Understandable. Are any significant projects still kicking off or moving forward?
Well, the report mentions one notable recent groundbreaking, the Signal Point apartment homes out in Liberty Lake.
Okay.
That's planned for 240 units, garden style. Construction started last August. So, activity hasn't completely stopped, but the overall pace is definitely slower.
Got it. A clear shift there. Let's move over to the sales side. People buying and selling apartment buildings. What's that market been like?
That also saw a major slowdown in 2024, a really significant one. It was actually the slowest year for sales volume in, over a decade.
How slow are we talking?
Total dollar volume was only about $80 million.
80 million. Compared to...
Well, the year before was higher, but the peak was 2022 when it was closer to $350 million. So a huge drop-off.
Okay, why the big chill in investment sales? Same reasons. Slower rent growth, higher rates.
Pretty much, yeah. Those are the key drivers. Slower rent growth impacts the income side, obviously. And higher borrowing costs push up what investors need as a return, which means cap rates go up.
Right, the cap rate. What's typical now versus before?
We're seeing cap rates generally in the 6% range now, whereas before, in the low-rate environment, they were often closer to 5%. Higher cap rates tend to mean lower sale prices, which makes deals harder to pencil out for both buyers and sellers.
Makes sense. Has the type of buyer changed at all? Is it still mostly local folks?
That's been an interesting shift. Historically, yeah, private investors, often local or regional, dominated, maybe making up 90% of the deals.
And now?
They're still the biggest group, but we saw institutional buyers, the larger funds and companies, become more active in 2024. They accounted for about a quarter of the sales volume.
Huh. So bigger players stepping in more. Why do you think that is?
It probably reflects, a broader recognition that Spokane, despite the recent slowdown, has pretty solid long-term fundamentals.
Like what?
Well, there's still strong underlying demand for apartments, and Spokane keeps attracting people moving in, often from more expensive cities. That net migration is a big factor supporting future rent growth potential, so institutions might see it as a good long-term play.
So even with slower sales, there's confidence there. Can you give us a few stats from the deals that did happen over the last year? Average price per unit, things like that?
Sure. Over the last 12 months, the data shows about 48 comparable sales. The average price per unit was around $128,000.
Okay.
The average total deal size was about $2.3 million, and the average vacancy rate when these properties sold was 7.1%.
Any specific examples stand out from late 24 or early 25?
Yeah, a few. Let's see. Parksburg Apartments, that's a 3-star, built in 79. 56 units it sold last October for $5.8 million. That works out to about $103K per unit. Vacancy was pretty low, 3.6%.
Okay.
Then in February this year, Union Park Apartments Older, 1971 build, 58 units went for $5 million, which is about $86K per unit.
Yeah,
Vacancy was higher there, 13.8%.
interesting range.
Right. And another one from February 25, the Montgomery apartments, much newer, built in 2023, just 24 units sold for $4.345 million. That's way higher per unit, about $181K, and vacancy was 8.3%.
So yeah, a real mix depending on age, condition, location, vacancy.
Exactly. Shows the variety in the market.
Good examples. Okay, finally, let's just briefly touch on the wider economy in Spokane. What's the backdrop here?
Well, Spokane is really the economic hub for Eastern Washington, right? The main commercial center for the whole inland Northwest. Its location is key, kind of linking Seattle and the coast with the interior.
And that's attracted specific industries.
Increasingly, yes, especially transportation and logistics. We've seen Amazon build a big presence, and the airport is undergoing major expansion work.
How's the overall economy doing? GDP growth.
Last data we have for 2023 showed Spokane's GDP growth was actually a little bit above the national average.
That's positive. And the job market. Has it shifted away from older industries?
Definitely. It used to be more reliant on natural resources, but it's diversified quite a lot. Now the biggest sectors are education and health services, government, and then retail trade. Think Fairchild Air Force Base, Providence Health, Amazon, those are major employers.
Is there anything specific in the economy that's really impacting housing right now?
I'd say affordability is still a major theme. All that in-migration after the pandemic really pushed up housing costs, including rents.
And incomes haven't kept pace?
Generally, no. Population growth has moderated a bit from the peak, but median incomes in Spokane are still below the national average. So that gap creates real affordability challenges for a lot of people.
Okay, that gives us a really solid, comprehensive picture. Q1 2025, looking back at 24. So, wrapping this up, for you, our listener, what are the absolute key takeaways?
I think there are two main things. One, the construction boom has cooled significantly. That slowdown is the big story right now.
Right, less new supply hitting the market.
Exactly. Which leads to takeaway two. We expect vacancy rates to gradually improve this year, and that, in turn, should allow for potentially stronger rent growth to return. Maybe not immediately, but over the next year or two.
But that rent growth part depends heavily on the economy staying strong, jobs, people moving in.
Absolutely. That's the crucial caveat. Economic health will dictate the pace.
So, understanding these shifts, the cooling construction, the potential for vacancy to tighten, the link to the economy that's really valuable intel if you're involved in Spokane multifamily, isn't it?
Precisely. Whether you're investing, developing, managing properties, or just trying to understand the market, this context is, well, it's essential.
All right, here's something to really chew on then. We've got this slowdown in new supply, but we also know there's still underlying demand for housing in Spokane. How do you think that tension, that balance, will ultimately shape investment strategies and maybe where the opportunities lie in the next, say, 6 to 12 months?
That's the million-dollar question, isn't it? It really forces investors to think critically about submarkets, property types, and potential risks as the market finds its new equilibrium. It's definitely a dynamic situation.
Definitely something to keep a close eye on. Well, this has been incredibly insightful. If you, our listener, need more detailed market data or want to discuss specific insights, you should definitely reach out to Eric Peterson with ACTIV8 Real Estate.
That's right. He's a great resource.
You can give Eric a call directly at 509-903-9077. Again, that's 509-903-9077. Perfect. Thanks again for joining us for this deep dive today.